Thank you. It hasn't been long, has it? It hasn't been long enough. Mhm. Mhm. Okay, thanks, Marlon, and thanks all for coming. We're just going to leave the disclaimer up there for a second. I do like to put that up there. One of the things also, just bear in mind that as we talk about trading, uh, everybody who talks about trading is talking about it from their own perspective, their own risk perspective. So also bear that in mind because that's not in the disclaimer. And, some things that I do, you might not be comfortable with doing and vice versa. Right, so this is me. I always like to start off with a picture of me so you know who you're talking to. There are a lot of screens there. That is not my desk. That is me at a prop firm in London. And I'm actually talking to you from Thailand right now, which is where I live. So the prop firms are our customers and our partners. So I get to see a lot of what goes on in the prop firms. And like probably a lot of the traders, people like Marlin, Danny, one of the other sides of trading that you don't hear about so much is just the general chatter that you have with traders as well. So one of the things, if you don't at the moment have trader friends you talk to regularly, especially if they're inside the industry, it's a really good thing to have people to have a natter with. Mostly because you get to have a better feeling for the issues they're having, and also you get to bounce things around. Sometimes you'll say something that they didn't notice, they'll say something you didn't notice. So that's a really good resource if you can get hold of some people who trade. And I can tell you, if you've ever been to a party where people are trading, where people are well, normal people are not traders, and somebody asks you what you do for a living, and you say start to talk about trading, eyes glaze over. Nobody wants to talk about it. So you find that traders Okay, you'll find that traders are very generous with their information once you get to know them. Right, do we still have audio? Can anybody hear me? A couple of people say they don't have the audio. Cool, cool. If it goes again, let me know. I'll restart my preamp. Okay. So today's goal, we're going to look at something which is a building block for your trading strategies. It's not the most exciting thing ever, right? So it's not like we're going to say, we're going to show you a setup that's going to make you $1 million. But this is something that will very quickly help you assess the state of the market as it evolves and help you evaluate which strategies may be appropriate as you move through the day. So if you've seen today, we've had a day where it started off very slowly. And as the day unfolds, there are things that you can look at with correlated markets that tell you when it's switching gear from that kind of really slow chop into something a bit more exciting. So we'll look at how correlated markets are often used, who uses them, and some of the misconceptions. And we'll also look at what's going on behind the scenes that causes correlations to be of value. Now, correlations will help with your trading. You don't have to use them, right? There are some entry techniques that you can employ purely based on correlations, but I'm not going to really talk on those today. I'm going to more focus on fairly simple techniques that will help you to improve your existing trading method. So it's a building block, it's a layer on top, something to enhance your trading. Things like helping you stay out of trades that would otherwise immediately go against you, helping you get a better entry price, helping you understand where the market is switching gears. If one of the things that you hear a lot from traders is, a lot of people say, I want an indicator that tells me when it's moving from trend to chop, right? And that is one of the biggest challenges in trading. And there is no indicator that can do it for you, but the correlations can help. But that in itself is one of the holy grails of trading, right? To know when that switch is being made, and the correlations can help with that. But basically, correlations are effectively enforced relationships between markets. And when I say enforced, I mean they're enforced by a certain type of trading, which many of you probably already know, called arbitrage, right? And to put it simply, when you have two markets that are considered to be related, or it's generally accepted that those markets are related, and there's a divergence between them, there are traders whose job is to jump in, buy one, sell the other, and make money when the markets come back in line. And here's an example, for instance. And this could be any two markets that are related. But the key with arbitrage is it doesn't matter what happens to either side of the trade. You've got a buy and a sell. It doesn't matter what happens to the buy. It doesn't matter what happens to the sell. It only matters that they come back in line. So this trade that you can see here is exactly the same, just as profitable as this trade you see here. It just looks different. So profit comes when the markets come back in line. Let me just make sure I've got a cursor. I don't think you can see my pointer, but I'll carry on anyway. So profit comes when the markets line up again. And the interesting thing about arbitrage, it's a bit like a dog chasing his tail, is that the arbitrage trading itself is one of the things that forces the markets back together. So in a way, you can say that arbitrage trades are available because correlations exist between instruments. But you can also say correlations between instruments actually exist because of arbitrage traders. And it's one of those funny things in trading, a bit like, trying to figure out all the relationships. It's best to not think too deeply about it. So if you look, for example, at the correlation between the Dow, NASDAQ, and S&P 500, they're all US stock indices. They've all got different stocks in them, but they're all part of the same stock market and part of the same economy. So you're not likely to see the Dow Jones sink for 6 months while the S&P 500 rallies to new highs in the same period. So what happens when these instruments do move in different directions in the short term is that arbitrage traders step in. And it's a competitive market, right? So the other thing about arbitrage traders, you might have a 20 tick divergence, but somebody's willing, instead of taking a 20 tick, somebody's willing to jump in ahead and take an 18 tick divergence. And effectively, when they do that, they help close the gap to 18 ticks. So it's a competitive market, and it's one of the markets where HFT really helps us, right? So HFT trades are effectively causing the arbitrage or causing the markets to move together. They're taking the arbitrage trades, what a lot of HFTs are about. And a lot of people say that HFTs are moving the markets and all that, but a lot of it's just about arbitrage. But that is only when the arbitrage trade is on, because it's not always on. So what makes this interesting is that arbitrage trade is not always on, and the correlations are actually quite inconsistent. But there's two types of inconsistency we need to understand. There's kind of a longer term inconsistency. So 10 years ago, it was quite normal to track quite aggressively inverse relationships between stocks and interest rates. If you go back that far, you'll remember, the 10-year, 10-year goes up, the stocks go down. It used to be quite reliable, and see that playing out intraday over and over again. One went up, the other went down. As we went through a period, though, we had all these financial problems, and interest rates got down to zero. They're even going to go below zero at one point, right? So we saw interest rates go to zero and just no chance of anything happening to them for years. And what they did with those interest rate products, it just broke down, it killed the interest rate products. A lot of prop firms in Australia that do interest rate spreads, they went out of business. And, we saw that correlation or inverse correlationship break down. Not a huge problem for us. We can just use something else, right? But there is a kind of a longer term, the possibility for certain relationships to break down longer term. And we'd expect really that as interest rates get a bit more interesting for that relationship to come back. Then there are times, okay, when the correlation breaks down intraday. Now, I mean breaking down for minutes or breaking down for hours. And that in itself is really good news, right? So the fact that correlations break down, if you really understand correlations, the fact that sometimes they don't work is actually really, really good news, because that inconsistency is one of the things that helps you understand the state of the market, as we'll see soon. So like I said, let me just repeat that. The fact that the correlations are inconsistent makes them more useful. It's counterintuitive, but it will become clear in a few minutes. Okay, so what correlations are more about than trying to play follow the leader is participation, because there's a difference in how you trade a slow, lackluster market like today and how you trade one that's bubbly and exciting and lively. So if there's healthy participation, you'll see high correlation, which means a better chance of follow through on a trade on one of those individual markets. But if no one's interested, the markets will often just chop around doing their own thing. So if you see low participation, low correlation, you likely see chop, lack of direction. If you see high participation, you like to see follow through. So it's this old trend versus chop determination. With correlations, you're going to get to be one of the earliest people who recognizes that the market switched from trend to chop and vice versa. So as an example, if the Dow Jones is currently moving up and the Nasdaq is currently moving down, the chance of chop sideways action on the S&P is really, really high. Chance of a pop or follow through on the S&P is really, really low. Start watching this from tomorrow and you'll see it. Now, of course, you need to observe it yourself, but just consider the markets like, these two parties here. Sometimes they're lively and sometimes they're not. Sometimes the arbitrage trade is on and sometimes it's not. So if it all goes quiet from a correlations perspective, you're going to get the earliest heads up that we're entering a slow period, a choppy period. Now, before we discuss what to look at and how to use correlated markets, it's worth talking about what this isn't, right? Because a lot of people think that when you watch multiple markets, that you're looking for a leader. So I can get questions from people saying things like, does NASDAQ always move before the S&P? And it would be fantastic, wouldn't it, if it did? You could just watch the NASDAQ go up and buy the S&P, and that would literally be free money. So I'm afraid that it's not like that. Sometimes, obviously, there are times when there's a clear leader, right? It can be a clear leader for hours. It could be a clear leader for all day sometimes. But that's kind of the exception, not the rule. But when it does happen, you can take advantage of it. So don't come to this thinking you're going to watch one market, wait for a move, and then trade another, because that's a bit unrealistic, certainly, as an ongoing strategy. It just happens sometimes, and you can take advantage of it. But when it does, you'll take advantage of it, but it won't happen all the time. So where do we see these correlations? Well, there's two places you can look for correlations. One is the DOM and one is the charts, and there are actually advantages of each. And what we'll do, we'll start looking at the DOM first and we'll switch to charts later. But the bottom line with correlations is that the number of correlated markets is limited, right? So you can't, if you trade the S&P, there's not 100 correlated markets. So you might personally like to trade and work with more volatile markets, but you might find the correlated markets available for you for that market are much thicker and slower. And if that's the case, that's just what you're going to have to use. You haven't got a choice. So if you're used to watching the DAX and you're looking for a correlated market that's as fast as the DAX, there isn't one. Well, there's not one that I know of, right? So you're going to have to watch something slower. Usually it's the Euro stocks and the S&P, and the Euro stocks is really quite slow. So you don't really have a choice about what kind of correlated market you're going to watch. But basically, for slower, less volatile markets, the DOM, depth of market works better. And for faster markets, the charts. So what we'll do, look at an example. And here we've got four markets. We've got the Russell on the left, which is more for decoration than anything. Russell is a stock index, but it's not really very useful for correlations. Now, the Russell used to trade on ice, and it moved to the CME. Is it last year or the year before? And initially, it was traded really lightly, and it really hasn't picked up to in my mind. It's got a bit more volume now, but it just doesn't seem that highly correlated to the other indices. So we're left with the Russell on the left, the NASDAQ, the Dow, the NASDAQ, and the S&P. The S&P is the slowest, and the NASDAQ is the fastest. Now, the white line, let me just see if I can get this pointer working. Can you guys see my mouse, my cursor? Wake up, guys. Can you see my cursor? I'll presume you can. No, okay, I'll presume you can't. Okay, right. So the white line at the center of all those depth of markets is just the center line, and it can be reset at any time. And this is an essential component of reading correlated markets, right? So we're not trying to read all of the numbers here, right? Most of the time, we just want to eyeball how far the markets have moved from that center line. So you see the big white thick horizontal line in the middle. All we're going to be trying to look at is how far we move from that line. So you think about correlations, this is something you're going to layer on top of your existing trading. And so it shouldn't take most of your energy. It's a quick eyeball thing. And what we're trying to eyeball is movement away from this line, or to eyeball the balance of trade, right? So if you look at, for instance, on the second from the left, the Dow, you can see on that inner column where you've got the blue 20 at the top, you can see there's more trade on the buy side, basically. And that's just a quick eyeball. If you have to try and add the numbers up, then you can't eyeball it. It's too much energy, right? So you're trying to see the balance, and you're trying to see how much it's moved. So it should be enough to quickly glance across at the dome and see that within 1 or 2 seconds, right? So correlations is going to help your strategy, but it is not your entire strategy and should not take all your energy. So in this image, on all of the depth of markets here, in terms of trade execution, the Dow, the NASDAQ is heavier on the buy side. S&P is a little bit mixed. Now we can see the 4 meters below. That's showing the pacer tape, and basically they're all in the yellow mostly. Market isn't spiking, but we just see nice, good average upside momentum. So basically, we're in a market moving up. S&P is at the top of the day's range. So is NASDAQ. Dow isn't at the top of the range, but it is moving up. So you can see what we've got there. We've got an order on the NASDAQ for 10 contracts. So basically what this is, it's a breakout trade. Now, as the NASDAQ is a lot more volatile, this order isn't quite at the top, because with the volatility of the NASDAQ, you should be able to get enough volatility to give you a bit of price improvement. So whether you agree with going long at this point or not is not even remotely important. What is important is to understand that right now there is a lean in the market. A lean, as in leaning one way. So you can see here, we've got the tower leaning one way here. It's leaning to the left. Not sure if the leaning tower pizza leans to the left or the right, or I guess it's a matter of perspective. But, if you look at that now, you could say certainly the chances of that falling down to the right are actually quite low. And the markets lean too. So when people consider correlations, they usually think about movement, but some markets can actually trade a lot without moving. But if they're heavily one-sided, then they're known to be leaning in one direction. It's called their leaning, right? So in the short term, if your market and the correlated markets are leaning in one direction, the probability of a short-term move in the opposite direction is quite low, right? So that's one of the major benefits of correlated markets, being able to tell that right now it's not going to pop against me. So it kind of represents a short-term safety net for any trade you take in that direction. So it's not a stop loss. It's not a setup. It's a safety net. If you can recognize that the market's leaning in one direction, there are certain trades like breakout trades you can take, and you can get out of that trade if that lean disappears without really losing any money, right? So it might be easier to think of it this way. Let's say this is the Dow Jones, the NASDAQ, and the S&P. 3 markets, all heavily imbalanced to the sell side. So you'd see normally the NASDAQ and the Dow would be tearing down, and maybe the S&P had just got to a place that you consider to be support on the S&P. This is the opposite of having a safety net. You've got 3 markets moving down, And even though, you see these people trading where they draw horizontal lines and that's where the market's going to stop, I'm going to buy it. If you're trading correlations, you're still going to look at that price, but you're going to be watching the way that the market's trading down, right? So in this case, any trade to the upside is not a good idea, right? So like I said, this is the opposite of having a safety net. 3 markets moving down, aggressively trading into the bids. Might just be better to wait for a sign that the markets are slowing down, going neutral, or starting to lean to the upside. So it doesn't mean you've got no trade. It just means you might want to wait a little bit. Okay, this isn't rocket science. So what you could do, for instance, if you want to go long on the market on the right there, the S&P on the right, you could wait for the Dow and the NASDAQ to level off a bit. So you might want to wait for this, right? So now we've got the Dow neutral, the NASDAQ pointing up, and the S&P still pointing down. It's still not great. To the upside, or at the very least that they become neutral. Sometimes what you'll do is you'll see the markets go neutral and then just wait for one of them to start to tick up, right? Okay. So if the markets start leaning in the opposite direction when you get into a trade, okay, have I still got you guys? I'm seeing I have a connection issue. Okay, I think I'm okay. So if the market starts leaning in the opposite direction to your trade, or it becomes neutral, then you can reassess. You can cancel orders, you can exit the trade. So it's a little bit different to managing a trade based on a move against you in your market, but it's a lot more sensible. It's a lot more sensible than just saying, well, it's moved against me, I'll get out, right? You might have the market not moved against you yet. Your long S&P, the down the NASDAQ starts to spike to the downside, you get out of your trade, right? So in other words, you can manage the early part of a trade based on how the market's trading rather than whether price is moving against you or not. Now, this is short term. In some cases, the correlations are going to see you passing on a trade completely. In other cases, they're going to see you getting a better price. Okay. So what we've got now, we've got that 10 lot order has been filled. And what we've got on here on this particular dome, which is the Jigsaw dome, everything recenters when we get into a trade. So what we can see, all the domes have cleared, everything's recentered. One of the big benefits of using dome over chart is that you can recenter a dome and you can't recenter a chart, right? And I'll tell you, if you were looking, for instance, at a chart, there was like a 15-minute chart, it would be very, very difficult to say, right, from the point I entered on these 3 separate charts, on a 15-minute chart, have I moved up or down? Because you might just be in the middle of the candle, right? So DOMs are better like this. If you're not used to looking at a DOM, it just looks a bit strange. So like I say, is you can recenter the DOMs, you can look quickly at that and you can tell exactly how many ticks each of those markets moved since we recentered, right? So what do we see going on here? Well, basically, not a great deal. We've got the Dow, we forget the Russell because it's useless. Then we've got the Dow, it's just a little bit above the center line. We've got the NASDAQ at the center line and the S&P just around the center line. So not much going on. So basically, you're not going to jump to any conclusions yet. There's no lean against us and there's no lean our way either. Okay, moving on a minute. Here's a perfect example of seeing a lean on a thicker market. So what we can see, if you look on the right, you can see that the S&P has had 286 buys, and at the same time, the NASDAQ has moved up 12 ticks, right? Now, this is a little bit strange, but those two things are exactly the same, right? NASDAQ moving up 12 ticks and S&P just trading onto one side. It's the same thing. So even though one market's moved and the other one doesn't, the S&P is a thicker market. It takes a lot more orders to make it move. So if the S&P ticks up 1 tick, you're going to expect the NASDAQ to tick up 5 or 6, right? And that effectively is the same move on those two markets, right? So basically what we can see, if you look at the NASDAQ and the light blue numbers, you can see they're heavier on the blue side. on the buy side. You can also see the S&P is heavier on the buy side. If you look at the Dow, it's not quite so clear, right? So basically what we're seeing there is a market leaning to the upside. Even though the S&P hasn't really moved, this is actually looking quite good. There's no reason, certainly obviously the NASDAQ looks good, but even if you're trading the S&P, you wouldn't bail on that S&P trade. Okay, so NASDAQ's clear, S&P is less clear as it's just one-sided, but you know, still none of these markets has done much yet. Only the NQ has broken its range. So at this point, if the NQ falls and the S&P and the Dow fall, I'd say it's time to exit. Now, before I go to the next slide, I want you to focus on the center line for the Dow, the NASDAQ, and the S&P. And what I want you to do is when we change slides, I want you to figure out how long it takes you to see which way this market is leaning. You know, if there's really some emphasis on one side, right? So all you can look at is the center line and then the blue and pink numbers in the middle of those two domes. So I'm going to go 1, 2, 3, go. There's the new slide. Okay, so if you did that, how long did it take you to tell if the Dow, the NASDAQ, and the S&P were heavier on one side? We've got a bit of a delay on the chat, but if you can see, just to tell that one thing, it was a couple of seconds, right? There wasn't any in-depth analysis to know that those numbers were bigger on one side. Also, no in-depth analysis to know that the Dow's moving up and the NASDAQ's moving up and the S&P is kind of just barely breaking, right? And that's effectively all you should put in. That's effectively your total commitment as somebody who's using correlations. It shouldn't be any more than that. And then the skill on top of that is just looking for slightly more subtle variance. But for sure, you're not going through and adding up all the numbers. You're not actually counting exactly how many ticks. So it's moved 9 this time and 10 the time before. It's not that precise, right? Because you need to use correlations in the heat of the moment. So it can't be a science project. It has to be something you can process quickly. So looking at those middle columns there and the move from the center line should be something you can process without too much effort. So there's two ways you can use this. If you're trading DAX or NASDAQ, very volatile instruments, you can expect a lot of minor swings in a move up. So this overall lean in the market can be used to stay in the trade, to understand the minor swing is just that because the overall lean is to the upside, or to get in a trade. After all, if the NASDAQ puts in a minor swing to the downside, but the overall lean is up, we can actually enter the NASDAQ when it puts in that minor swing against us because we know it's going to go, there's a good chance it's going to go back up. That's very useful if you miss a move. So that's looking at market depth to use correlations. We can also use charts. So let's look at the same three markets. And this is really really key. This is what I do on the S&P every day. We've got the Dow at the top, NASDAQ at the bottom, and I've still got the S&P dome on the right. And we can see that right now, both the Dow and the NASDAQ are breaking upside. So for me as an S&P trader, all I want to know is, are the Dow and NASDAQ moving together? But what's really important if you're going to use correlations is the time frame, because we're looking for real recent action, local action. So if these two charts were like 30-minute charts and we're in the middle of a 30-minute bar at the moment, you wouldn't be able to read the nuances, the subtleties of how it's moving. So this is actually a 10-second chart. So you can see I'm actually looking back. I've got about 28 minutes of action on there. And I'm not looking at every little bar, you know, but I'm just trying to, it's about 28 minutes of action on there. And I'm just trying to see if they're moving together right now. So if you're using correlations, it pays just at least for your correlation work, keep the time frames low for readability. Anyway, we can see that the Dow and the NASDAQ were not well correlated earlier on. You can see that the Dow had gone up, sorry, the NASDAQ at the bottom had gone up and then it's moving down. But you can see the Dow hasn't gone up. It's just in a downtrend, right? But right now, they're actually moving together. So if you just look at the past few minutes action, they're both actually moving up. So at that earlier point in time with low correlation, we would have expected a low participation, non-directional moves on the S&P. But now that's a market that switched gears. So even within, I don't know how many bars there are now, but there's probably 2 or 3 minutes in that move up. That's long enough to tell you that this market has potentially switched gears. So it's 2 or 3 minutes from, potentially a range bound market for you saying, right, I think this market's now going to actually put in a move. Right, that's how quickly you can see the markets have switched gears with correlations. So at the moment, Dow and Nasdaq are moving together, which means there's a good possibility of follow through on any S&P trades. So for now, also the lean is up, because if you look at the dome on the S&P on the right, you can see it's a lot heavier on the buy side. So we've got the Nasdaq leaning up because we can see they're moving up, and we've got the lean to the upside on the S&P. So if we take long trades now, we kind of get have a bit more breathing room in those trades because of that lean. So once again, what I'm going to do is I'm going to go to the next slide. And at that point, I want you to just look at quickly the Dow chart, the Nasdaq chart, and the numbers on the S&P dome, and have a think about what you can see in terms of correlations and how long it takes you to see it. Okay. So basically, it's effectively the same as last time. It's just a chart view rather than a dome view. So what we can see healthy participation up in all three markets. We've got green bars on the chart on the right. Those green bars are green and red. They're colored by balance of trade. So a green bar doesn't mean we moved up. It means more buys and sells. So we can see that the lean is on the buy side on all three markets. Now, you might say, well, this is all very obvious. And I would agree 100%. Because if it's not obvious, then you'd be overanalyzing it. So, and for sure, when you see situations where they're not obvious, then just you're not getting a read from it, and it doesn't tell you anything. Okay, so what do we do now? We start to see a bit of a counter trend move. So we can see that the top, the Dow, is coming back a little bit, and then the chart underneath, we can see the Nasdaq just starting to move down, and we can see the S&P has backtick a few ticks. Right? So we're looking at a high participation, healthy, correlated set of markets. What we don't want to do, we don't want to get out of every long trade because there's a little pullback of 3 ticks, right? So if we see pullbacks in all three markets, it doesn't mean it's a reversal. It just means they're correlated. We expect them to pull back at the same time. So Dow's moving down, ES off a few ticks, but again, there's no strength in the move, right? None of them have really pushed down strongly, because you're going to see all markets pull back together, but it doesn't mean you have to get shaken out of a trade. In this case, it's pretty clear that the move isn't strong in any of those markets. And once again, this is trade management techniques I'm discussing, but you could actually just as easily enter here long on these markets off the fact that you've got three markets trying to pull back and not getting anywhere. We've got an upward direction. We've got a short-term move back that looks weak. And we've got overall healthy correlation, which is good for follow through. And we've got a lean to the upside. If we got it long and then we start to see it leaning to the downside, we get out, right? So it's not an entry technique we're talking about. It's not really a management technique. It's a market reading technique. So be open-minded about how you use this. Okay, and the market's continued up. We can see a pullback. You can see the little pullback here on the Dow. You can barely see it on the Nasdaq below now when you look at it. And of course, you could have traded any of those three instruments, because this isn't just about trading the S&P. It's just an example of the sort of activity you see in correlated markets and how they can be of help. Now, the last thing we'll look at is this concept of switching state, going from trend to chop or chop to trend, and how correlations help with that change in state, because it's going to be a little bit uglier than you're expecting. We don't want to just look at pretty charts. Right, so for the moment, and again, there is a bit of a delay on the chat, so I won't ask you too many questions. Do you think those markets, just ask yourself, do you think those markets look correlated? And the answer is no. Nasdaq's up, the Dow is down. Now, what I will say, if you're trading the S&P, it's a lot more important what the Dow and Nasdaq are doing, right? So there are actually only two directions, right? So if you've got three markets, then two of them are going to be doing something similar, right? But if you're trading the S&P, it really seems to me that on the indices, it's the Nasdaq and the Dow that really set the tone. right? But anyway, you can see that. You can see the Nasdaq's up, the Dow's down. You know, you could argue that the Nasdaq and the S&P are both up, but like I say, there's only two actual directions. So of course, there's going to be some similarities. So this is where the experience comes in. Like I said, if the Dow and the Nasdaq aren't in the same direction, more often than not, S&P is going to chop. So, like I say, US indices, assessing market state, comparing it to Nasdaq and Dow is key. And as you move through the markets, you're just going to have to get experience to figure out which correlations you're going to use and which ones are key. Now, as you can see here, we move on. The Dow is still marching down and the Nasdaq still moving up. And this can go on for hours, you know. But if you look at the S&P, we've got direction in the Dow, we've got direction in the Nasdaq, and look at the S&P. It's moving sideways. This is absolutely typical. So what we can see here, you know, we've got those markets moving in the opposite direction. A long trade at this point, when the S&P, as you can see, we've just come down to where the lows are. I don't consider a long trade here to be a reversal trade. This is a range trade. So we take that lack of correlation in the Dow and the Nasdaq to determine that the market was directionless and look to fade when we see that, you know, we're at a low and fade at a point where we think the market's about stopped, right? Now, this is important because the best place to enter in a trading range is the worst place to enter in a trend, and vice versa. So trend and trading ranges require absolutely opposite strategies. So it's good to have a heads up as the market shifts from trend to chop. So in this case, correlations are clearly giving us a heads up right from the start that we have a low energy, low correlation market with poor chance of follow through. And in this case, there's not going to be a trade on here, but I just want to go over the activity. So if we had strong movement down on the Dow as well and the Nasdaq, there is no way you would go long here. But as they're not correlated, and as we're at the low in the S&P, the chance to follow through is low. So if you just look at the bottom at 90.50, how many contracts have traded? We've got no contracts there at 90.50 on the S&P. And we move on. You can see as we move up, that was as far as we got. But now have a look at this and ask yourself, is this correlated or not correlated? Because if I look at that myself, I would say that's correlated, right? So there's no breakout, there's no spikes up, there's no big move, but we actually have the markets in sync again. They've kind of got that U shape. Each of those markets got that little U shape at the end if you look at the past few minutes, right? Just look at the shape there. We can see they started doing the same thing. So when we look for the correlations to pick up again, don't think of it as all three markets necessarily pushing dramatically in one direction. Just look for them being in sync, right? This is ugly, right? But this is what it looks like, right? So the appearance now is that we've actually switched gears from a correlation perspective. And so the chance to follow through is decent. So like I say, it's not pretty, but it is correlated. So don't necessarily wait for pretty. Don't wait for big, bold, brassy moves. Don't wait for the market to pop. It's the subtle stuff that is the most rewarding in trading, in my opinion. Stuff that you can see and tip your hand maybe before others are seeing it. So like I say, in this case, markets are in line, ugly, but in line. And here's where we ended up. Another 4.5 points of quite ugly, but directional action. And you can see there's even, if you look at the circles there, you can see there's even areas on the charts with the circles, which show us where a lot of size traded, like at 926 there. I'm actually 12 hours ahead of you, so that 926 is actually just before the open. You can see that area of absorption. So you can see there is a real good correlation. Now, so for me, having watched this for quite a number of years, I find it really, really difficult to tell from just one market if we're reverting to range mode. And most chart-only traders will need to wait for the extremes of the range to hold one or two times before they can take a trade. Correlation traders have a much better view of the shifts in the market as they appear. Now, none of this could be considered rocket science, right? So we can boil it down to a few useful and fairly easy to implement things. So one, we can better understand the current state of the market. If other markets are clearly against you when you want to get in, then you wait. If the other markets are clearly with you when you want to get in, it's giving you a big safety net. And like I say, you have to observe this for yourself. But when you see that lean across a bunch of correlated markets, it really reduces the amount of backticking in that market. It's not like it's not going to backtick at all. But if you've seen it backtick like 5 or 6 ticks and then it all starts leaning up, it will be reduced. If other markets go against you after you get in, then the probability of a winning trade is much reduced. And it's really about the markets, partly about the markets leading or being heavy on one side. In a thinner market, that produces a visible move. In thicker markets, it's just visible we trade heavy on one side. So if you take the Euro stocks, for instance, trades thousands and thousands of contracts as well. Certainly 500-600 is normal to trade on one side, but it will tick up to another price. So if you're looking at the DAX, while the Euro stocks is trading 1,000 contracts on the buy side, DAX has moved up 20 ticks. And that is exactly the same move, right? It just looks different on different markets depending on the liquidity. And it all takes a bit of experience. So don't expect to sit down tomorrow and master it in one session and then get all angry and throw it away if it doesn't. Get used to how your markets move. Find the most reliable correlations because there are plenty to choose from. And occasionally there will be a leader, but the value of correlations is about more than follow the leader. Just that is an occasional nice thing to have. Now, some markets don't have many correlations. Crude oil is a good example. But with crude, there are different calendar periods used by spreaders. There are other energy products. The dollar index. Somebody recently told me that the Canadian dollar is a really, really good indicator for crude, right? So there is stuff out there. There were quite a lot of times, if you were watching the markets in 2018, there were lots and lots of days where crude and S&P broke almost at the same time. Right. I mean, it was just like sometimes, and sometimes you'd get crude break a minute before the S&P and it would give you good heads up. And that was just something that was, to me, it was something I either hadn't spotted before or it just seemed to me something that was really prevalent in 2018. So just be aware that the benefit is more useful on some markets than others. A lot of interest rates traders use these correlations. So we've looked at index futures mostly today. Interest rates, very, very similar, having good correlations. You can look at grains, meats, metals, all interesting. Then there are particular trades that also have a low requirement for correlations. So if you're trading the news and you're seeing a news event and you're trying to only get on that news event when all three markets are pointing in the right direction, it's not going to happen. Like they're all over the place, right? So news trades, trades after the FOMC, for instance, volume spike, exhaustion trades, the kind of more violent trade types are the kind of trades or the kind of times where the individual markets more tend to do their own thing. So as such, it's a lot to expect correlations to help on those markets in the same way. Now, as I said, correlations are just one of the building blocks of your trading strategy, and it's probably one of the easier things to adopt into your strategy. In fact, taking a kind of building block approach to trading is actually a much more effective way to develop than just looking for new entire systems all the time. After all, what you've seen here, you can apply to almost any trading technique. It's a completely independent skill. It's not really a setup. There are correlation setups that you can take. It's partly a way to recognize different states of market, partly a way to reject trades, and partly a way to manage trades. So you could build up more building blocks of things that are independent of a particular setup. So if you go to a proprietary trading firm, they also build up a series of skills in their traders. And what's quite interesting in the prop environment, so I know a lot of really good traders in prop firms, but I also know the people that taught them how to trade, right? And without exception, the best traders in the prop firms are way better than the people that taught them how to trade. Now, there might be some people that won't talk to me tomorrow after I've said that. But as you move forward as a trader, it's great to absorb lots of good information in sessions like this that you get here. And it's always good to hear new approaches, but that's kind of going to take you so far. It's like about 50% of the equation, because half of trading is kind of learning those techniques, and then the other half is you. So some techniques you'll be good at, some you won't. And you don't want to spend a lot of time and energy on those that you won't. So in a prop firm, they generally start you off trying to trade a relatively new set of markets and setups, but with the addition of things like correlations to help and different building blocks. And it helps to keep the traders focused. And at the end of every day, every trader has to take a step back to start going through this process of understanding what's working for them. So this way they find out what works for them, what doesn't work for them, and what bad habits are impacting their trading. Now, you might think that that shouldn't apply to you, but this is the process that allows traders to go beyond what the person that taught them how to trade, or beyond what, beyond the skills of the person that taught them how to trade. So basically, you learn to trade, you collect the information about your trading, and you review it over and over again, always understanding the issues you need to work on and always moving forward. So once you've reviewed and understood the issues you've got, like for instance, you might not realize how much you're leaving on the table when you're trading, but when you review at the end of the day, that is pretty obvious, right? And of course, what we do at Jigsaw is we try and help you in each of those steps. So we try with the education part, we have the trading platform, then we have cloud-based analytics to help you track what's working and what isn't. But what makes us experts? Well, we have won a number of awards for our products in trader voted contests. And if you do a Google on us, all over the web, you can Google us and you can find out what people say about us, like this review from Warrior. Not that I actually know who Warrior Trading is, to be honest. It was just, this is something a customer pointed out to me recently. And I'd agree, we've got an effective trading platform, and they say we've got the best order book trading resource on the market. And that's nice, but there aren't many order book resources on the market. There's about 4 or 5. So I'd agree we have one of the best. It'd be difficult to have. We've probably got one of the worst as well if there's only 5 out there. And of course, our customers tend to agree, but what we do, and again, what you learn here, Mr. Topstep, it's all about being rewarded for your efforts by layering in good techniques like correlations on top of other good techniques. Because neither we nor anybody else has got a magic system that's going to make you profitable tomorrow. So we give you tools, education, analytics to do the job, and then we'll support you on that journey with one-on-ones, chat room, and with guest speakers that we bring from the professional training world. So let me tell you the way it works at Jigsaw, and what we do is we do have 3 packages. Independent is basically for those that are almost there and want to use order flow techniques to improve their trading. So that comes with lifetime access to the platform and the analytics, and 10 hours of order flow education that is best in class. So if you want to dip your toe in the water with order flow, that's the one you go for. If it's just like, I'm not sure about this order flow thing, just go for that one. If you don't like it, 14 days later, just ask us for your money back. We have the professional, which is another 7 hours of education material from Jigsaw covering specific advanced topics like scalping techniques, some advanced trade management techniques, volume profile analysis. And then we got the big one. The top package includes all of that, plus 6 hours of live trade videos from a prop firm in London. Now, this is quite amazing, and nobody believes this. You probably won't believe it when I tell you, but it's 6 hours of trading with voiceover explanations of what's happening during those 6 hours. It's not 6 hours of consecutive trading. It's over a number of days. And during those days, he's swinging his account like $100,000. Like I say, the videos are over a series of days, right in the middle of the Brexit panic at the end of October, early November. And over the course of those videos, the trader actually makes 7 figures. And I'm not saying you're going to make 7 figures because you're not swinging 500 lots on markets, right? But it is an amazing insight into what goes on at the elite level of trading. Now, on top of that, we also have a study at home price ladder training course, also comes from the same prop firm, that teach you the setups they teach their intern traders. Now, it's something unique in the trading world, as it's the only package I've seen anywhere that gives you live traders from a professional trader, making 7 figures over the course of the videos. It gives you the education from a prop firm, platform designed and used at prop firms, and a trade analytics platform also used by prop firms. And today what we've done, we've added in 2 special items to that: a live trade license and the upgrade to the professional version of the analytics system, which adds on a real-time audio newsfeed, economic release alerts, and more advanced trade tracking for analytics. So if you got those three components, it'd be just under 2,700. But today, if you do sign up in the next 24 hours, next 10 traders, you can get that for just $16.99. You got to use the coupon code Mr. Topstep, or you'll be bugging me tomorrow for the $100 discount to do manually. And with that, does anybody have any questions on correlations or trading in general, or what prop firms do? I'm more than happy to answer. Do any of you use correlation? I'd be interested to know which of you actually use correlations already and whether this matches what you actually do already. Yeah, oh, that's a really good point, Tick Trades. At the open, yeah, again, the open is one of those times when the markets get really, are really active and really and moving a lot. And I would absolutely agree that that's a pretty poor time to use correlations. It's like, 5-10 minutes in, when it calms down a little bit, that's when the correlations are much better, in my opinion. Yeah, I didn't actually realize. I think I ended up sharing the wrong screen. Should have just shared the slide. So sorry about that. Okay, so I don't think we've got any more questions. The good thing about correlations, right, is that you don't. I haven't done crypto tick trades, no. The good thing about correlations is that you don't have to take anybody's word for whether they work or not, because you can actually look yourself, and it doesn't take you any more energy because you're already sitting down anyway. So the great thing about correlations is, it costs you nothing to start looking at this stuff, and and you don't have to take it on faith. But I think with that, Marlin, I think we are okay. Yeah, hear you fine. Yeah. Hey, they know it all already, Marlin.